Hello students, today we will take up one problem on dissolution of partnership firm. Here is the problem. Sushant and Prashant are partners sharing profits and losses in the ratio of 2:1. They decided to dissolve their firm as on 31st of December 2002. Their balance sheet as on that date is as below. See the balance sheet. On the liability side, you have sundry creditors 16,000, general reserve 9,000, capital accounts Sushant 22,000, Prashant 22,000. Then come on to the asset sides, plant and machinery. Come to the asset side, plant and machinery 25,000, furniture 4,000, stock 10,000, sundry debtors 20,000, cash at bank 10,000. The total of the balance sheet is 69,000. Then we have some additional information here. The assets are realized as under: number 1, Sushant took over the plant and machinery at book value less 10%. Then Prashant took over the stock at rupees 7,500. Debtors realized rupees 18,500. Then 3, creditors were settled at a discount of 5% and dissolution expenses amounted to rupees 1,000. Prepare realization account, partners capital account in the bank account. This is a very simple problem, and now we will solve the problem and look at the solution of this problem. First, we have to transfer all the assets to the realization account and then the liabilities. When we are talking about liabilities, it should be external liabilities. You have only one liability there. Now first we will transfer the assets. Except cash and bank balance, everything is to be transferred. So you make one entry to sundry assets, below that plant and machinery, the same book value, the balance sheet value. Plant and machinery 25,000, furniture 4,000, stock 10,000, sundry debtors 20,000. The total becomes 59,000, which you take in the outer column. Then we have to transfer all the liabilities, external liabilities to the realization account. You have only one liability there, by creditors rupees 16,000. After this, you look at the adjustments. Then you will find there is one adjustment, that plant and machinery being taken over by Sushant. So the entry will be Sushant's capital account debit to realization account. So here it will be by Sushant's capital account. In bracket you write plant and machinery 22,500. He has been taken the plant and machinery at 22,500. Then stock is taken over by Prashant. Again, Prashant's capital account debit to realization. So here it is by Prashant's capital account rupees 7,500. Then debtors are realized at rupees 18,500. You get the cash or bank. So it is bank account debit to realization account. Here it is by bank, debtors realized 18,500. Then they have sold off the furniture, that is again by bank rupees 4,000. The furniture is being sold. Then go to the debit side, see creditors are paid, that is to bank 15,200, sundry creditors are paid, and you have the expenses of rupees 1,000 to bank account, in bracket expenses rupees 1,000. Then calculate the profit or loss on realization. So here the debit side is heavy, take the total 75,200. So then there is a loss of rupees 6,700. Calculate and see. The loss is to be transferred to the capital accounts of both the partners. So by loss transferred to Sushant's capital account and Prashant's capital account. Inner column you write the distribution: 4,467 and 2,233. The ratio is 2:1. After preparing the realization account, go to partners capital account. We have Sushant and Prashant as partners. When you open the account, first put the opening balances. So here by balance brought down, Sushant 22,000, Prashant is also 22,000. Then if you look at the balance sheet, there are some reserves. Put those reserves, distribute them to the partners in the ratio of 2:1. That is 9,000 are the reserves. So 6,000. Sushant and Prashant is 3,000. There are entries. If you look at the partners capital account, there are entries. The stock is being taken over by Prashant and the plant and machinery is being taken over by Sushant. So that entry will come here to realization. Sushant 22,500 for plant and machinery, and to realization, no need to write two entries in the same column. You write to realization 7,500 Prashant, which is stock being taken over by him. Then the loss which you have just calculated, 4,467 and 2,233, that is to be transferred here. Same entry to realization, 4,467 Sushant and 2,233 Prashant. The balancing figure is the payment that you will make to the partners to bank, because finally we are settling the accounts. So this will be the payment, final payment. Make the total 28,000 and 25,000. So the balancing figure to bank 1,033 and 15,267. So this is what is partners capital account. Now we will look at the bank account. Now we will see the bank account. When you open the bank account, transfer the balance. To balance brought down rupees 10,000. Then see the debit side. Debit side of bank account is the receipt side. You have these entries which are on the credit side of realization account. They are transferred here. So one is debtors realized and one is furniture sold. Say about furniture, nothing is mentioned in the problem. So there is an assumption that if nothing is mentioned in the problem about the realization of fixed asset, you have to consider that the asset is realized at the book value. So furniture is realized 4,000, debtors realized given 18,500. So you have receipts of 32,500. Come to the payment side, you have made the payment of rupees 15,200. Okay, then that is creditors being paid. Then realization expenses rupees 1,000. In the final payment which is made to Sushant and Prashant after settling that account, by Sushant 1,033 and by Prashant 15,267. So that comes to 32,500. So here the bank account should tally, the receipts should be equal to the payment. So we took very simple problem on dissolution of partnership firm. When the balance sheet is given to you, then you have to prepare based on the information, you have to prepare realization account, then partners capital account and the bank account. Two assumptions are very important. One is regarding the payment of liability. If nothing is mentioned in the book or in the problem about the payment of liabilities, you have to make the payment of liability, third party's liability, that is for sure. And one is regarding realization of fixed asset. If nothing is mentioned in the problem about the realization of fixed asset, that is selling of the asset, you have to assume or you have to consider that particular fixed asset is sold at book value and consider it as that you have received cash. That's it. Keep watching.